Good morning, good afternoon, and good evening, everyone, and welcome to the Winter 2023 M&A Bootcamp. My name is Colin Mahan, and I'm the Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you're going to see in the chat in just a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. A couple of housekeeping items before we get started. Firstly, let us and the other attendees know where you're dialing in from in the chat. Secondly, we're going to open up for live Q&A at the end of each panel, so please submit those questions for us in the Q&A function at the bottom of your screen throughout the presentation. We'll try our best to get to them all. Now, none of what we do here at the center would be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, Microsoft Entrepreneurship for Positive Impact, BPM, and HubSpot for startups. We're humbled by their contributions and hopeful you're grateful too. Now, I'm going to launch a few polls before we get started to take a step back and take a temperature gauge on how all of us are feeling about our businesses today. So we have been taking this poll for quite some time now to measure sentiment, to provide wellness and other additional resources for the entrepreneurs in our community. So let us know how you're feeling about your business. Thank you for participating. Looks like we've got San Francisco Bay Area, Silicon Valley, Miami, Vancouver, San Diego, UK, Ohio, awesome. Tennessee, welcome everyone. Boston, great. SF Bay Area, really good mix. All righty. Thank you for participating in that poll. My second poll today is going to gauge where you're trying to learn the most today. So what side of M&A are you looking to learn about? On the sell side, are you an entrepreneur looking to see what M&A looks like? Are you looking for the buy side to learn a little bit more about how corp dev's looking? So let us know. Thanks for participating. Ooh, it looks like we got a pretty good mix. All righty, I'm going to end this poll. Share those results just so you can see, but yeah, almost a pretty close split, but a little bit more on the sell side. So for those of you who are looking for the sell side, the first panel is totally for you. So before we get started, I'm just going to quickly cover the agenda for today. So we're going to kick off the program with an M&A market update, and then followed by an M&A strategy for early to mid-stage entrepreneurs panel. Then we're going to have a quick 10-minute break and transition into our second panel, where panelists will share the growth through acquisition, buy-side overview, and insights. So for those of you looking for the buy-side, that's for you. Please note the same Zoom link will be used for both sessions. So without any further delay, please join me in giving a warm welcome in the chat to our presenter to share the M&A market update. Chris Hedrick is a Managing Director, Co-Head of Technology and Business Services, Middle Market M&A at BMO. Chris, welcome.
Thanks, Colin. I appreciate it. Can you hear me?
Yep.
Okay. All right. Well, good morning, or shall I say good afternoon for folks on the video here. Once again, I'm Chris Hedrick. I really appreciate everybody joining and look forward to a good dialogue here. I've got about 7 or 8 slides that I'll go through. I know I've got 5 or 10 minutes. What I'm going to try to do is try to hit the high points as I walk through this, and hopefully you guys can get a copy of the deck after, and there's a fair bit of information and detail in that you can then go through following. And I'll leave a little bit of time for questions at the end of my walkthrough here. So if we can turn to the next page and start, this is the 10-year perspective of the global M&A market, just to put everything in perspective here. And so I think it's interesting to start here and look at the top chart. What that's showing is on a yearly basis, looking at the bars, that's the aggregate deal value globally for M&A. And then the line is the deal count. So what you're seeing is a steady growth year over year over the past 10 years, which isn't too surprising, recognizing we've had low interest rates and a really solid economy, both here in the US and globally. And what you're seeing in 2020 is a drop off because of COVID, which we all obviously lived through and understand. And then a solid pickup in 2021, nice rebound. Some of that was pent up demand, and some of that was sort of driven by, improvement in interest rates and activity from that perspective. And then a little bit of tailing off in 2022. And I'll get into that. There's some sort of, some macro headwinds coming into the market in 2022, inflation and fears around that, and obviously the raising of interest rates. And I'll talk about some of those points later in the presentation. So just to sort of put that perspective, if you look at the bottom chart, I think it's also interesting to think about the distribution of deal count by region globally. So once again, if you just look at sort of what's happening there, some of the points to look at is the Asia Pac, the light blue there in the stack, has gone from 10% in 2012 to roughly about 20% of deal count in 2022. And then for US market, about 45% going down to just below 40%. So anyway, just some sort of high level points. So if we can turn the page and take a look. Now let's drill into the US M&A market. If you look at the chart in the lower left, that's the last 5 years annually for just US transactions. A similar look, a little bit of debt, a little bit of additional sort of, pulling back in 2019. But you'll see that dip in 2020 due to COVID. Once again, a rebound in 21 and a little bit of pullback. So consistent with the prior page. But what I think is more interesting is to look at the chart at the top there. So that's monthly activity of US deals. And that's the last 2 years within that dark blue is January, okay, from a monthly perspective. So what are you seeing in 21? A nice solid year and a build of transaction value at the back end of the year. So a real solid year, just as we saw on the prior page, but also transaction count building too. And once again, I think you got to always think about M&A as a little bit of a lagging indicator to the market. So those are deals that are coming in the pipe and then finishing up in 21. And then you're seeing what's happened in 22. A little bit of you can see that depression and coming down, and then sort of a flat to slightly declining deal count over the rest of the year. I did one adjustment in October because as you can see, there's a little bit of gray on the top of that bar chart or the bar, because there was about 4 or 5 deals in the footnote, one of them being Twitter. So it was a little bit of an outlier month. Otherwise, and so it gives you a better picture without that to see sort of what really transpired during the year in the US activity. So there's definitely fear in the market in terms of, inflation, interest rates and some of the macro trends going on, on a monthly basis. So, and then some of the other charts just on the bottom right, in the middle, and then in the far right corner, just break down the US deals by size. And so those are over the last 10 years, 2012, 2017, 2020. And what you're seeing is that, no surprise, there's been a shift to bigger deals. So in the case of the one in the bottom middle, that's deal count by size. And you're seeing a shift of 83% of deals less than 250 million in transaction value, going down to 72 in 2022. Once again, part of that is that deal values have gone up, and so you're seeing a movement. But you're also seeing in the far right, when you look at it by value, you're seeing that spread going in 2012 is 27% of the deals were 5 billion or above, going to now 52%. So bigger deals occurring, obviously values going up. So turn to the next page. So here's another cut of the US data, looking at it by sector. So the top chart is looking at it by value based on the broad sectors there in the legend on the right. And the things I would point out is look at the top gray boxes. That's the energy, materials, and resources sector. Once again, by value, they were in last 5 years. So 2018, they were 22% of the value of the deals. And now we're looking at 10%. And the other one that I think no surprise probably to everybody on the call here is technology, which in 2018 was 11% of value, and now has gone up to 31%. So a much bigger part of the transactions. And then if you look at it just by deal count and the distribution down below, pretty consistent across all the sectors, both from 2018 to 2022. So that's remained pretty consistent across the board. So we'll turn to the next page, talk about cross-border. There's a fair bit of things, a lot of things going on over here, but I think the real takeaway here is not a lot has changed. So this is looking at US deals and whether you're looking at either a domestic buyer or in the case, looking at a foreign buyer looking at US targets. And so if you look at the top chart, the important thing to look at is the dark blue in proportion to the overall deals. And that's remained pretty consistent at 15% of deal volume or deal value across the time period. And then if you look at it in the pie chart, sort of where did those foreign buyers come from when you look at 2000 over a course of 10 years, 2012, 17, and 22, not a lot has changed. There's a little bit of Asia Pac coming down as a percent, okay, in terms of volume, and in North America going up, but it's basically remained about the same. So it's been pretty consistent. So turn to the next page. Now to cut that data and look at by sector and valuation multiples within each of the sectors. And just to give a trending of where these are going over the last 3 years, and you'll see. Most of the sectors here have gone up. Once again, no surprise. Now we know the market has had some gyrations and obviously had a big movement yesterday. But M&A, once again, is a lagging indicator. And so a lot of these deals were sort of in process and either going through approval or getting sort of going to closing when we look at those. So there is some pressure now coming into the market where there's a little bit of a bid-ask spread with buyers and sellers. But overall, you know, the trending of multiples has been pretty solid in most sectors. The two that I'd point out is one in the middle is the consumer sector. That's obviously had a compression. Both in the top chart is revenue, LTM revenue to enterprise value, and the bottom is LTM EBITDA to enterprise value. So the consumer has seen a depression in that sector. Once again, not too surprising when we think about, you know, that's more predicated on disposable income in retail sales. And then also the energy sector has had both a little bit of a contraction there from multiple, not too big, but a little bit. So turn to the next page. We also, when we think about M&A, is sort of who are the big players. We all know that private equity and what we refer to as sponsors have been, you know, more and more active over the years, rather than just strategic buyers. And so once again, there's a lot going on here. This is over the last 5 years, looking at it on a quarterly basis, group by year. But what I would tell you to focus on, at least for this call, is look at the lines. So what's happening is that's a percent. In the top, it's deal volume, so count. In the bottom, it's deal value. And what we're seeing on deal count is that private equity over the years is really getting to parity, getting to sort of a 50-50. So they were, you know, if you look back 4 or 5 years, they were more at 40% of deal volume were sponsors buying those targets versus strategics. And now it's coming up to 50%. They have pulled back a little bit at the tail end of Q4 of 2022 and then into sort of year to date, which is what that is, that stub. And then from a value perspective, they're sort of below. There's some gyration there. If a big strategic does a big deal, then the valuations get a little out of whack in the percentages. But basically what you're seeing is that the strategics are definitely becoming obviously more and more active and very competitive relative, sponsors are, more and more active and relatively competitive to the strategics. But just from a valuation standpoint, they're just maybe a tick or two below that. So turn to the next page. So I think here's some charts. I always think it's important when you think about making sure we understand the buyer's availability to capital and their willingness to obviously participate and pay good value for assets in the market. So here's some data and things we look at. The top chart being on a yearly basis, the aggregate value of private equity capital raised, okay? And then the number of transactions or funds that are raising that capital is the line. So you're seeing that over the last 10 years, it's continuously been pretty consistent, moving upward to the right, okay? And it's how much is raised each year. But you're then seeing there is a drop off in 2022. So that sort of dropped off. And there's some gyration year to year, but it's consistently been pretty strong. So they're still going out there raising capital, and they're actually doing it at a more aggressive or a faster pace than, you know, in recent years than they have in the past. Now, the middle is probably more important to that, which is how much, what we call dry powder or committed capital do they have that they haven't put to work yet. And so that remains very strong. It obviously has pulled back a little bit in 2022 relative to what was in 2021 at 1.4 trillion, but it still stands at 1.3 trillion about. So they've got a lot of capital to put to work, and they're always looking for good assets to do that. But the other sort of counter to that is the interest rates. And you can see, we all probably have lived this and know this, but you can see where the interest rates have been pretty low over the last 10 years. They moved up a little bit before COVID. COVID hit in 2020, it came back down. It's pretty low, which obviously had that bounce back in 21. And now they're ticking up, which is having somewhat of that sort of the headwinds into the market in 22. So turn to the next page. And so what does that mean for 23? And I don't have a perfect crystal ball, but I mean, these are some of the things that, are out there, and we got to sort of think about and see how they impact and affect, different businesses. So there is some uncertainty out there, and there is somewhat of a spread between what I said, the bid-ask spread of what, buyers tend to adjust fairly quickly to valuation adjustments, where sellers, it takes a little bit of time to sort of calibrate. So, there is some uncertainty, both inflation and interest rates. Obviously there's a good thing. There's a tight labor market. In some respects that can be good. But in other respects, it's creating some friction in terms of companies able to go, get talent or have to pay more to get that talent. But then we're obviously seeing in the news, some of the large sort of mega tech businesses, talking about either not hiring or laying off some people and sort of the impacts there. And then there's obviously geopolitical impacts in the market, and then what that's doing to the global supply chain, which I still think needs to be sort of, worked through the system. So ultimately, buyers really, my experience at the tail end of last quarter and into this year, they're very focused on nearer term profitability versus, growth at all cost. So, ultimately, the idea is, well, are we going into a recession, a soft landing, or a rebound? And it's hard to tell, but I'll tell you one thing. As I said from the prior page, there's a lot of capital out there, and fundamentally, but whether you're strategic or whether you're a sponsor, they're looking for good assets. And one of the things they're doing is spending a lot of time and attention making sure that the business model and the business has resiliency and strength and quality in the market that they're playing in and going into 2023 and then going forward. So I'll pause there. That's sort of my prepared, Colin, conversation. Hopefully that's helpful, and people can have a copy of the draft and go into it in a little more detail. So
awesome. Thank you so much, Chris, for that overview and update and optimism. We really appreciate it. People have been asking in the Q&A for the slides, so there aren't any direct questions for you, but really appreciate you joining us for this.
Great. Well, thank you very much. Appreciate it.
Awesome. All right. Well, folks, before we jump into our next session, I'm going to launch one more poll that will help us understand in our next panel in the next 3 months, how many of you are exploring M&A as an option? So fully looking into it, not ready, or you're just here to learn more. Let us know. This will help our next panel understand where they should dial in. All righty. Thank you all for participating. I'm going to end this poll in a moment. All righty. I'm going to share these results. Looks like a lot here to learn more, fully looking into it, and some not ready yet. So great. Thank you for participating. So up next, welcome our special guests for our M&A strategy for early stage entrepreneurs panel. We've got our moderator, Donna Pawar, is our founder and chief product officer, also Center Advisory Board member. We've got David York, who's global strategy partner at KPMG. We've got Luke Parson, who's partner, senior vice president at Woodruff Sawyer. And we've got Brendan Mahan, partner, mergers and acquisitions at Wilson Sonsini. Welcome, team.
Hey, good morning.
All righty, Donna, over to you.
Thank you so much. Hello, everyone. I'm Donna Pawar, and I'm so very excited to be here with you all today. Thank you again for joining us. And I'm expecting this to be a tremendous panel. And you'll hear why in a little bit. A little bit about me. As Colin said, I've been on the Nasdaq Center's advisory board since its inception in 2014. And today I work very closely with companies on fundraising, scale, and M&A. And this panel is really special to me because I clearly remember the day when my first company was acquired and how exciting and nerve-wracking it was. I jokingly say that I feel like Diddy, aka Puff Daddy, as almost all of the companies I worked for went through a name change, mostly because I've been lucky enough to be part of multiple acquisitions and or an IPO. And now it gives me even greater pleasure to have you meet our brilliant panelists, David, who's a global strategy partner at KPMG, Luke, who's a partner at private equity and transactional risk group at Woodruff Sawyer, and Brendan, partner mergers and acquisitions at Sonsini. David, Luke, Brendan, I would love to get started by just giving you a chance to introduce yourselves, starting with David, followed by Luke, and then Brendan.
Sure, thank you. Good morning, good afternoon, everybody. So as Dana rightly said, I'm a strategy partner for KPMG based in Silicon Valley, and I spend most of my life helping corporate clients with either organic or inorganic strategies. Nice to meet you. Look forward to sharing some perspectives today.
Excellent. Good morning, good afternoon, good evening, everybody. Luke Parsons here. I'm a partner, senior vice president with Woodruff Sawyer, one of the largest privately owned insurance brokerage firms and consulting firms in the United States. I lead the private equity due diligence practice where we help all of our private equity and venture capital clients on a variety of topics related to insurance, whether it's pre-close due diligence, reps and warranties insurance, or post-close insurance brokerage services. So very happy to be here. Donna, looking forward to the discussion. Thank you.
Hey everyone, Brendan Mahan here. I'm a partner in the mergers and acquisitions group at Sonsini. I'd say my M&A practice is pretty diverse with a pretty healthy mix between buy side and sell side clients and deals of all sorts of sizes and targets and all stages of development. So I'm looking forward to talking to everyone and having a good discussion.
Thank you. And as you all can see, we have an amazing panel here, and I just love the breadth of expertise. So audience, please post your questions in the Q&A section. We will try to get to them, to as many of them as we can. We've already received a bunch of questions ahead of time, so thank you for that. And with that, I'm going to start off with my first question. And this one is for everybody on the panel. As we heard from Chris, these are truly interesting times across the board. So have you seen the sell side evolve in the late 2022, early 2023? And what does this mean for startups who are looking to get acquired either this quarter or next?
Yeah, I'm happy to go first, and maybe Luke and Brendan, you guys could chip in. So, I mean, as Chris said on his previous slides, it's clearly an extremely challenging market. I think, I'm very focused on tech, and I think tech has found it even more tough going in recent times, and that's affected both buy side and sell side, right? So not many sellers wanting to come to market, given uncertainty around valuations, etc. And then from a buy side perspective, people being, very, very happy to kind of sit and wait, right, and see how the market plays out, not wanting to overpay, etc. I think what I have seen in the last, let's call it month and a half since the holidays, we have seen a few more kind of emerging shoots of sellers coming to market, right? Maybe thinking that, the summertime could be good timing. And obviously our business, is very highly attuned, right, to M&A volumes, right? If M&A volumes are good, then, we do well as a firm. And if M&A volumes are down, conversely, we do less well. So, we are, trying not to talk the market down. We're trying to be very optimistic in our conversations with buyers and sellers. But hey, there's a general uncertainty and lack of confidence out there, which I think is causing some hesitation in the market. So I think, I would say, it's still sluggish, but we are seeing some pretty early shoots of hopeful recovery on the sell side, Dana.
Love it. I love the optimism. Luke, do you want to go next?
Sure. Yeah, I would agree with David. Definitely saw the slowdown in Q4 comparative to Q4 2021. Obviously, all of the macroeconomic events are helping shape that. I have seen, as David mentioned, we've seen a little bit of an uptick the last month or so. So we work at Woodruff. I'd say a large portion of our business is working with private companies as they're going public. So we are the market leader in helping private companies place management liability programs for publicly traded companies. So we saw obviously a large slowdown there. I work with all of our private equity clients on the buy side and sell side from a due diligence perspective. So we saw a little bit of a slowdown there, but by and large, as Chris mentioned in his overall comments, there's a record amount of dry powder out there from a private equity perspective, and the private equity firms can't sit on that capital for very long according to their LP agreements. And if they're earning management fees, eventually they're going to have to spend money. It's just a matter of when. So I agree with David. By and large, what we're hearing is that banks are starting to send out books again. People are starting to get interested. Sellers are coming down to a more realistic expectation of valuation compared to a year ago. That's still going to continue to be the case, I think, over the next 3 or 4 months. I think we'll see an uptick in deal flow starting Q2 into Q3, and I think Q4 will see it come back into what we would consider quote unquote normal year, obviously discounting 2021 just of how large that year was from a SPAC and de-SPAC perspective. But obviously, we can't really gauge it too much, because if interest rates rise another couple points between now and then, it's going to completely throw everything into upheaval again. So we'll see. I'm very similar to David. I'm very optimistic about this year.
That's great. Brendan?
I agree with everything that David and Luke said. Just to kind of add what we're seeing on the ground, I think the most notable evolution that we've seen is that despite there being a large amount of interest in doing M&A generally, it seems like it's pretty difficult to move that interest and convert that into getting an LOI signed, and also more difficult to get an LOI and convert that into a definitive agreement. So although we're seeing a lot of interest, it just seems harder to get deals done, even if that interest is there. I think as some of the other panelists said, I think often that's characterized by difficult valuation discussions and valuation gaps. So I think buyers are increasingly focused on their financing costs and lower valuations across the markets. I think sometimes sellers continue to base their price expectations on what they've seen in previous years, which is not how buyers are viewing it. So I think, that valuation gap is a hurdle that's often difficult to overcome. We're seeing a lot of people kind of explore creative alternatives to try to bridge that valuation gap. I think earnout's going to become increasingly popular, this year, to try to bridge that gap. I think we're also seeing buyers just being a bit more discerning over choosing their targets and their due diligence process. So I think our founders should also just be aware that I think, normally feedback we get from people, particularly that have been going through the sale process for the first time, is how extensive and exhausting the due diligence process can be. And I think people should be prepared for that to be, frankly, maybe more robust generally than it is in the past, as buyers are a bit more discerning when it comes to picking their targets. I am an optimist, as Luke is. So, I think acquisitions remain an important way for companies to gain, technology that they think they need. And I think there's a lot of emphasis over buy strategies over build strategies still. So I think there's a lot of incentive there, but it is, certainly more challenging than it has been in, the past couple of years.
Love it. What a way to start a panel with a lot of optimism. And Brendan, just to continue your thought, the next question is really for you again. So what are the main legal points a startup and its board should consider when they're thinking or determining if it is the right time to sell?
Yeah, that's a great question, and I think one we often get. I think frankly, it's a bit challenging to answer, and I'd say, first of all, to not dodge the question, because I'll put a pin on the question in a second. But I do think that the main drivers are not frankly legal ones, but it's just comparing the valuations people expect versus long-term prospects and executing the plans. What's your alternatives, both from existing investors or new investors, or perhaps doing an IPO, and what you need to achieve your plan, and where, if at all, an M&A transaction may fit into that. I would say from a legal perspective, not to dodge the question, I think that just means running a good process, exploring all of those alternatives, having healthy discussions with your board and your key investors who you're going to need to have on board to do any M&A type transaction, and just setting those expectations kind of across your constituents. I would say also just keep in mind you have no obligation to sell. So that's certainly something you consider, but you're under no legal obligation to sell your company. I think people should also just keep in mind that these processes can take a very long time. So you might want to think about working backwards, from if you're thinking about an exit, when do you plan on having that exit, and when, do you think is the right time to begin having those conversations and those discussions? Because I would say, frankly, if you're thinking of doing a transaction and selling your company, in the 2023 calendar year, you should probably be thinking about that and having those conversations with your board investors, today. Because these transactions can frankly just take a long time, and they're complicated to actually execute.
Oh, really sound advice, which is a perfect segue into the question I have for David, which is, given the fact that you need to start preparing early, what do startups need to focus on when it comes to due diligence, even ahead of having those M&A conversations?
Yeah, no, thanks for the question. I've done this panel a few times consecutively, and I always give the same answer. So apologies for those that have attended before. But for me, it's really all about being prepared, right, and being mindful. Brendan mentioned that both the length of time it can take and the imposition it can be on the rest of the business. So I just think, if you've not been through an M&A process before, Dana, I know you said you had a bunch of times, right? But, there are clearly things that everyone will ask for, like, because they get asked for every time. And I just think, being thoughtful around, hey, you'll need your tax returns, right? You'll need your employment contracts. You'll need your sales projections. You'll need a Q of E, right? There's a bunch of things that you'll be asked for, because any acquirer, under the sun will ask for those things. So I just think having a structure, whether it's just a simple Google Drive where you create all these artifacts as a repository, but doing that ahead of time, I think can be really helpful. And then the other thing is, there are always areas where, buyers will want to probe further, right? Whether that's because there's a bit of uncertainty in your storytelling, or because it's more directly aligned to the investment thesis that the buyer has. So again, I just think being thoughtful and mindful about, hey, where are likely acquirers going to want to probe? Like, where are they going to ask for supplementary detail? And, it not being an unseemly scramble, or, seemingly to catch, potential sellers off guard with, oh, hey, I didn't really realize you need this really obvious thing. And again, as I said in my intro, I deal with a lot of, big corporate buyers and big corporate sellers, and even they don't have this, M&A can be a little bit of a surprise to some of those folk as well. And I just think you can make life much easier for yourself by being thoughtful, being prepared, being well structured. It's not very exciting and it's not very sexy, but I just think you can take a lot of angst out of the process, right? Just by getting prepared early. Dana is what I would say.
Oh, this is super sound advice. I mean, most of our from the poll we heard, most of our audience is really looking to learn more and starting to get prepared, right? So this is great advice that you start early, and if you start from day one, then you're not scrambling at the very end. So it's super sound advice. Luke, this one's for you. Can you discuss how reps and warranties insurance works, and how is this beneficial? When is again the right time to think about this?
Sure, yeah, I'm happy to do that. So reps and warranties insurance at its most basic form is breach of contract coverage. So the contract in this case would be the underlying purchase agreement that the seller and buyer will agree on and negotiate throughout a transaction process. So typically throughout the due diligence process, throughout the purchase agreement negotiation, the seller will make representations about their company. Their projected revenues are this, their contracts are these people, our taxes are this. It's very similar to what David said. All the items you're going to talk about during diligence, you're representing that those are true and factual to the best of your knowledge. So post-close, should something happen where there is a breach of one of those representations, or something that the seller said during the negotiation and transaction process turns out to not be true, whether it's at no fault of the seller or if there's actually a fraud situation where the seller blatantly lied during the sale process, every purchase agreement, and when I say every, I'm talking by and large, I'm talking a standard stock transaction in this case. A seller will be required to hold a certain amount of money in escrow for a certain period of time, normally 18 months or 2 years, whereby if there is a breach of one of those representations during the transaction process, the buyer can go against that escrow in the form of and gain indemnification for that breach. It's a lot of technical jargon. I apologize. I'm trying to be as layman as possible. Brendan, I'm sure you get this question all the time. So a reps and warranties insurance policy seeks to replace or otherwise provide an additional backstop for that indemnification and corresponding escrow in that purchase agreement. The reason why that's important is a typical escrow in most transactions is, call it 10%. Some transactions, depending on the industry class, may have additional escrow. So for example, if you have a $100 million transaction and you're selling your company for an enterprise value of $100 million, the escrow that's required to be held back for that indemnification package under the purchase agreement for potential breaches of reps is $10 million. So a reps and warranties insurance policy seeks to replace that entire amount of escrow with an insurance policy. So you have a $10 million insurance policy. What that does for a seller is that opens up that $10 million that otherwise would be held in escrow to the seller to at closing versus in an escrow account for a period of 18 months or 24 months. And it provides an alternative solution for the buyer to seek damages in the event of an inadvertent or blatant breach of the representations under the purchase agreement. Again, very technical insurance jargon, I apologize, but there's no other real way to explain it other than that. The key benefit for sellers is that it makes available to them additional proceeds at closing that otherwise would have been held back for a certain period of time. Key implications from a buyer perspective is you have a sum of money that you can quote unquote go after in the event of a breach. You don't have to actually go after the seller who may or may not be a part of the team in an M&A transaction.
Yeah, no, and this is great. Honestly, I think technical jargon is good because it's also good for everybody to start getting familiar with these terms and really understanding the process. And we have some people on the sell side as well on as part of the audience. So I think this is really great advice for them as well. So thank you for that. And just to extend that thought a little bit further, Brendan, this one's for you. To continue that train of thought, from a legal perspective, where do you see deals getting stalled? And do you have any advice for our founders on how to avoid the pitfalls there?
Yeah, no, that's a great question. And I mean, I think it is a perfect segue because I think one way to avoid some of the friction in the deals is to use rep and warranties insurance for all the reasons that Luke described. I would say, one way that we often see deals stall is because the parties leave a lot open in their letters of intent and kind of a desire to move to the next stage and kind of continue the negotiations. And that can often just create friction later when all of those issues kind of come to light. So I'd say that if there's issues that are important to you, I think when you're negotiating a letter of intent, it's important to lay those out there and get those clear up front. I think oftentimes, the buyers will try to leave the impression that the LOI is essentially some sort of formality to kickstart the process and the details will be worked out later. But I think it's important for founders to understand that, there is a perception of a shift in leverage after you've signed the LOI, because that often comes together with an exclusivity that binds you to negotiate exclusively with the buyer. So, if there's points that are important to you, it's important to, not leave those open in the LOI and to have those conversations up front. I would say, frankly, for buyers, it can often be the same, which is that even if you think your leverage is going to increase by signing an LOI and kind of having those discussions later, if there's really terms that are deal breakers for you in terms of indemnity package or what you're in demand of the founders in terms of rolling over their equity or revesting their equity, it's important to have those up front rather than just punting those conversations later and kind of having those difficult conversations weeks down the line, which can cause delays. I would say another key point is just keeping your board and investors in the loop. I think one way for really things to kind of go awry and to have transactions stall is, if you haven't kept a board member or a key investor who you need to execute the deal fully in the loop, you think you've negotiated your definitive documents and everything's fine. You present that to your investors and they say, I don't want to sign that. I care about XYZ terms, and you kind of have to renegotiate everything. So I think just keeping your constituents in the loop throughout the process and making sure everyone is kind of on board with how the negotiations are going is also a good way to make sure that deals don't stall.
Yeah, I've seen it so many times where founders don't really have those honest conversations with their board members early on, and it seems like a no-brainer, but there's so many factors why people don't do that. So that's great. And just really, again, reminding everybody in the audience, please do post your questions. I do see some really great questions there. No question is a bad question, so please do post them, and we'll try to get to them at the end. David, this is a question we get a lot from founders. How can startups appear more attractive to buyers and acquisition offers?
Yeah, I think, just to keep it brief, the one thing that I would think about is, what is the strategic value of the business to the acquirer, and how can you maximize that in their minds, right? I don't know the scale of some of the businesses we're talking about here from the audience's perspective, but it is unlikely that, all facets of your business will be equally attractive to a potential acquirer. So whether they're buying you to take some IP, for example, or some rehiring, whatever it might be, I just think being really clear in your own mind around why you're attractive in the market, and then basically being able to sell to that value proposition, right? And being really able to emphasize on that value proposition. And then, when you think about then the presentation of your business through, some kind of sales side documentation, whether it's a sim or whatever, again, I just think being very clear about, okay, this is why, I think we would be a good fit together, right? And this is why the vision of this could look like X. So 1 + 1 is greater than 2. And I see lots of sellers be kind of distracted by things that are peripheral, things that haven't yet scaled, right? Things that they're, very excited about, but perhaps the potential acquirer won't be so excited about. And I just think being very clear about, hey, this is the investment thesis under which the buyer is operating, and this is how I'm going to maximize the investment thesis and then maximize my own exit, I think is really, really important. So, there's a bunch of other stuff that I think is important too, but I think being very clear about, hey, look, the buyer wants me for this reason or these 2 reasons, and I'll be very clear and articulate around how I can maximize the combined value of those things, I think is important.
That's great. And look, on the other side, I mean, we talked about the attractiveness of a startup and the strategic value to a buyer, but how should startups think about risk when it comes to being acquired?
It's a great question. I think in general, buyers want to see that what we see on our side, coming from the buy side perspective, buyers want to see that a company, whether it's a startup or a company that's being considered for a buyout in a private equity transaction, they want to see that the company is properly protecting and mitigating impacts to EBITDA in a negative way. Said another way, they want to make sure that you are protecting the aspects of the business that if there is a loss or an incident in that area, it could tank the business's EBITDA and make it a less attractive asset to the buyer. Sometimes that is insurance, sometimes it's transferring the risk in another mechanism. But what we tend to do is we focus in my group and at Woodruff Sawyer on helping clients effectively protect and improve EBITDA margin incrementally from an insurance perspective. So we help startups and we help other firms strategically think about how they can otherwise take care of a risk that the company faces, whether it's a known or unknown risk to the company. We're the experts that come in and advise them of those risks, how they mitigate those risks, whether it's by insurance or whether it's by other mechanisms of risk transfer. Again, it's all about EBITDA protection. Most of the times the buyer is you're going to be assessed on a multiple of your EBITDA, and they want to make sure that EBITDA is being appropriately managed and protected. I say this a lot, David. I think I say it on every panel, similar to you too. But another thing the buyers want to see is they want to understand you as the seller or founder of the business are not an expert in some areas. You're an expert at running your business, at growing the business, scaling the business. You might not be an expert in insurance. You might not be the expert in legal. You might not be the expert at finance or tax. Buyers want to see it at an early stage of your development, as you've even prior to thinking about selling your business. They want to see that you're engaging expert people to help you along that path to make sure you're setting up mechanisms by which you can protect yourselves adequately. So when it comes to a sale, the buyer comes in and says, oh, you've worked with Wilson Sonsini for the past 3 years. We're pretty confident you're buttoned up from a legal perspective. You've worked with KPMG on your tax and accounting. We're pretty confident your audits are going to be buttoned up and there's not going to be any major issues. Those are type things. Shameless plug. You work with Woodruff Sawyer on your insurance. We know your insurance is going to be pretty buttoned up and you're ready to go. Those are type things we think about at an early stage. Again, if you start thinking about these things 3 months before you're going to try to sell your business, the natural question to the buyer, where they might do some probing, as David said, is why did you only do this 3 months ago? Or what was the thought process and how did we get to this spot?
Yeah, no, this is great. I mean, again, the recurring theme, right? Start early, prepare early. Knowledge is king, and which is why we're here now. And so this is all very sort of perfect timing, I think, for the audience listening to this, preparing for a potential M&A. Brendan, this is again a question we get asked way too many times, and obviously for obvious reasons. A lot of startups I speak with are worried about protecting their sensitive information, their IP. So what is your advice on protecting competitively sensitive information, especially during the very early initial discussions?
That's a great question, and one we get often too, of course. I think when you're having the early discussions, I think it's important to take a step back and kind of just consider why are you sharing information and what do you think the buyer is going to need that information for? So for example, if you're in kind of a pre-LOI stage, I really think the information that you ought to be sharing at that stage is the information that's going to get a buyer to a number to propose something in an LOI for you. So that doesn't mean you need to give away the recipe to the secret sauce at that stage. So I kind of think that at those preliminary discussions, that's kind of like SIM level information, like organizational documents, financials, history of financing rounds, cap table, a profile of revenue and customer base and kind of things like that. I don't think you really need to divulge, a whole lot at the very early stages. I think, once you have an LOI, you should definitely be prepared for a fulsome diligence process. And that's kind of when you open the floodgates for information. I think process-wise, you can also consider limiting access to particularly sensitive materials, to particular individuals. You may actually be required by antitrust rules to have clean teams where only certain individuals can look at information anyway, if there's competitive overlap. So I think you can consider siloing certain information like that. I'd also say, obviously, having a robust NDA is an important part of the process, since that's your legal recourse for protecting the misuse of your information. If I may just take a short aside on NDAs, if I may, I think those are also just important from the process perspective, because it's usually the first time you're ever negotiating with a counterparty. So I think that can really set the tone for how the negotiations go as a whole. So not only is that document important for you to protect your information, but if you're setting the stage with the NDA negotiations of essentially rolling over on every issue, you can kind of expect that that's what's you set the groundwork for that to be how that's going to work throughout the process, which may not be setting you up for success.
Cool, that's great. So I'm going to switch over to Luke, and we're kind of up for time a little bit too. But Luke, you work with a lot of corporates and sponsor firms on the buy side. So how can founders learn from your experience working on the buy side with due diligence processes from the other side of the table? And David, if you can add to that as well, I would love to hear from both of you on due diligence and your learnings, and how can our founders benefit from that?
Yeah, it's another great question. I think my overall comment, and I will say this again, I think we're going to have a key takeaways here in a few minutes from each of us, but I'll say it now and I'll say it again. Engage an expert bench of advisors early and as soon as possible, and do a proper vetting exercise to vet those advisors. And once you have those advisors on your bench, use them. That's what they're there for. That's what we're here for. We're here to answer I'm here to answer any question the client has with regards to reps and warranties or insurance coverage, how to impact XYZ, how to impact EBITDA here, how to optimally structure the program there. We're here to help. And that's our job. That's why folks hire us to do their insurance work. That's why people hire Brendan on the legal side. And having an expert advisory team will help the process be more seamless and streamlined at the end of the day. On the insurance side of the equation, my overall recommendation is make sure you engage an expert to help you figure out what your exposures are and properly insure those risks. Insurance, after several hundred years in operation, is a fairly efficient market. If coverage is expensive, there's a reason why. If you're a software company working in the SaaS space in 2023 and you're trying to get cyber liability coverage, it's going to be expensive. There's a reason why. It's led by claims, and working with a team to make sure you've got adequate benchmarking and making sure you've got an adequate policy in place is going to help the buyer on their side, again, just be a lot more comfortable with you and your company as they go through their diligence process, simply because they know you're engaging people that have all the I's dotted and T's crossed. If again, taking the software example, if they come to you and you're a software company, a startup that's putting up $50 million of revenue, and you've got a $1 million cyber liability policy, it's got a lot of exclusions for ransomware and cyber breach, those are going to be the types of yellow flags that cause a buyer to really second guess what they're buying, why they're buying it, if the management team is not approaching experts and implementing those pieces to, again, potentially inflate the EBITDA of the company.
That's great. David, anything you want to quickly add there before we head to the takeaway?
So I had three things, one of which Luke touched on, right? The importance of advisors. I think that's really important. The other two things maybe are, I said this a little bit at the start, right? Don't underestimate the impact of an M&A process on the rest of your business, right? It's very time consuming. It's very distracting. If you imagine the very small number of people typically, under the tent right? It will be most of the leadership of that organization. And I think, smaller companies in particular can get really overwhelmed by, just being in the process and having to respond to all of the asks, etc. And, can neglect often the, general day-to-day operations of the business. So I guess I would think about, hey, look, how do you make sure that the business continues to perform strongly whilst you're in this M&A process? And then the other thing I think, and Luke touched on this, a little bit also, is, if you are well prepared, you can take a little bit of the tension out of the system, and nothing gives a buyer I guess pause for thought more than people who don't understand the question, or aren't well prepared, can't answer things about the fundamental running of their organization, and you can bring a lack of kind of confidence in the process, right, from the buyer's perspective. So again, I think that preparedness thing is really important as well.
Fantastic. Oh my God, what a panel. We can go on and on and on. I mean, I have so many questions. We're getting a lot of questions from the audience, which I really want to leave time for. So really, really quickly, maybe 30 seconds each. David, Luke, Brendan, in that order, key takeaways, just like the one thing you would want the audience to leave with today.
Yeah, I would just say, just be prepared, right? I feel like I've said it 50 times, probably too many, but it's an all-consuming process. You can make it much easier for yourselves and for your management teams just by being prepared and being thoughtful.
Mine, again, just like David, almost ad nauseum, I've said it, find a good group of expert advisors and trust them on their instincts, and allow them to be an expert group of advisors on your behalf.
Brendan?
I think we can leave time for questions, because I agree with everything that they said. I mean, I think just generally, I think maybe going back to the market overview at the beginning, I think the M&A market's certainly not as hot as it used to be, but I think there's a lot of optimism among this panel doing the right deals for the right terms. So just be prepared, and if you're entering a process, be prepared for a marathon, not a sprint.
Love it, love it. My key takeaway has been this is so much optimism, and just there's a clear path now, I think, for the audience forward. Again, lots of great questions. Thank you so much again to our panelists. Phenomenal panel. And I am going to now hand it over to Colin to help field some of the questions that we have been getting in the Q&A function.
Awesome. Well, thank you, Donna, David, Luke, and Brendan for that amazing overview. And yes, agreed. Love the optimism. And Donna, we get to invite your perspective on some of these in case you have some points to chime in with. So if you haven't already, drop your questions in the Q&A box at the bottom of your screen. We'll try our best to get to them all. So just to kick us off, general question to the panel, feel free to jump in on this one. What role does product and CPOs play in the selection and decision process for M&A? The build versus buy decision, and how a company fits strategically into a buyer. Any comments there? Potentially Donna, thinking you there.
Yeah, I mean, I've been running product for companies for a very, very long time. And honestly, this is not to punt the question, but when I build products, I don't think about, how is this product going to help me sell the company? I build products, because it's something that the market needs and the company's really passionate about solving that problem. So personally, as the head of product, I don't really think about how this is going to get us to sale. But eventually, when we start having those discussions, obviously those thoughts come in, and you want to work very collaboratively and do a few things, and all the things that we talked about in terms of due diligence, documentation, preparation. I think that's where head of product or CPO can help. But trying to build a product around sale is something, at least personally, I've never done. It's really more to respond to what the market needs.
Hey, Colin, let me just chip in there. So, one of the things I've observed is obviously M&A can be an accelerant, right, in the product organization. Typically with big companies, right, the lead time to get, is certainly to have a relatively mature product, the lead time to get new features, new functionality, etc., can be pretty lengthy. And so, one area where I've seen M&A work pretty well is as an accelerant to, hey, actually my CPO tells me that it's going to be, 18 months to get this thing in market, right? And actually we can buy this thing that looks a bit more flexible. It's got a different architecture, right? And we can plug it in, and bring it to market much faster. And I think there's always like a little bit of healthy tension, right, between, hey, do we do this internally and do we invest internally, or do we go out to, and risk some M&A process in order to try and accelerate that time to market. But I think that's healthy discussion, right? For any good organization is, hey, what's the fastest time to realize the vision that we have around product? And clearly that kind of buy build thing is an important part of that.
Super helpful. Another question here on integration. So there's the attendee saying the evidence, there's evidence that those acquirers that genuinely integrate their business are more successful than those who just play the roll-up game. Comments from anyone on the panel?
Yeah, I'm happy to swag at that too. So, I mean, I think there's room for both, right? As you've seen from a private equity perspective, there are different strategic approaches. No doubt successful integration yields more, yields incremental value, right? And that's where you see a lot of value being destroyed, is where companies don't get the integration right. But I think to answer that, I saw the question in the chat before. I think there's room for both. I think you just need to be extremely clear about what your strategy is and how you're trying to execute it. And if you go down because even with a roll-up, right, you're still fundamentally bringing those businesses together. The level of integration may be different, right? But you might have a combined product offering, for example. And so I would say it depends a little bit on the strategy that you're trying to execute, and whichever strategy you choose, you clearly then need to execute it really, really well, right, to the optimal of your ability.
Luke, Brennan, anything to add there? David, you nailed it.
Yeah, I agree with that wholeheartedly.
Great. Well, Brendan, I got a question here in the chat that I believe could be you, but feel free to chime in for anybody else. So what are some of the effects from the announcement by the SEC that investors will be liable for investing and not doing proper due diligence? Will that reduce the number of M&A transactions, especially VC?
I mean, I think it might. I mean, I think the SEC is also, cracking down and being increasingly skeptical of SPACs as well. So we're seeing that in that space as well, where the SEC is essentially saying, well, are these transactions really being properly due diligenced? Are you really, executing your fiduciary duties well? So I think it's yet to be seen, I think, completely. But I think maybe an analogy to that might be in the de-SPAC market, where the SEC has said in certain circumstances there could be underwriter liability for the CMAs, and I think in those instances, a lot of banks are being extremely cautious about that. So I think that will affect things. Yes.
Yeah.
And Colin, I don't know if it was David or you, Brendan, that mentioned it, but just in a tough marketplace like we're now, where deals are, kind of hard to come by and they're a little bit fewer and farther between, buyers are going to do more diligence just in general, and they should be. I think a lot of what's going on, especially in the VC market, where it's kind of fake it till you make it, things like Theranos and those types of litigation and outcomes, as well as the SEC chiming in, there's going to be a little bit more scrutiny on these deals going forward, which I think there should be. I think that's what the general population is thinking, is that, hey, we're giving you money on behalf of ourselves as investors, and we expect you to do your own due diligence prior to investing or buying a company. A lot more so on the venture capital front. Obviously, on the private equity front, private equity is used to having that kind of fulsome due diligence process. On the venture capital front, because they're taking such low ownership stakes in companies, historically they haven't done as much due diligence. I think we're going to start to see that change in a fairly meaningful way.
Super helpful. All right, we got a question here, industry specific. Are mainly tech startups the ones that think about M&A in the early startup phase? Is CPG very different? Seems like it might not be able to think about M&A until they're beyond the startup phase. Any comments there, team?
So Colin, I've worked with CPGs for a while, so I'm just trying to understand. So it says, is it mainly tech startups that think about M&A? Oh, so it's CPG, I'm guessing this question
is M&A for early stage just for tech startups, not for CPG, or is there any difference between CPG and tech?
Definitely a huge difference, just in terms of the criteria and the even the due diligence processes. But having worked with CPGs as part of coupons.com for a long time, you'll see a lot of the CPGs are now forming their own incubators, like pretty much everybody going from Kraft to P&G. Everyone has their own innovation arm, their own incubator, and their only job is to look for the next big thing, right, before it gets to become a true competitor, to acquire them and bring them in-house. So that definitely is becoming a big part of CPG's push, because again, they've become too big, the big companies, and they want to make sure they're always keeping their eye on the ball of what's new and up and coming. So definitely different processes, I would say, but a lot of activity happening on the CPG side, at least from the buy side early on.
Awesome. Luke, I got a question here. You mentioned the case, a hypothetical case study. So somebody is asking for the cost of the insurance for the hypothetical $100 million case so that they can see what the cost would be to them as the founder. Aware it depends, but looking at a range.
Yeah, no, it's a good question, and it's a good market update for the reps and warranties market in general. The market has softened significantly just based on the fact that deal flow is down. So in that hypothetical scenario, all else being equal, we're talking about a standard stock buyout transaction. It's $100 million. The limit on that policy is likely going to be around the $10 million mark. In Q1 2023, you're going to be looking at roughly 2.75 to 3.25, maybe 3.5% of that limit. So call it anywhere from $275,000 to $350,000 for premium. There's going to be some taxes and fees as well as some non-refundable underwriting fees that go into that. But generally speaking, from a pure premium and rate perspective, that's what I would assume that for nowadays. And trust me, your legal folks who are helping you on your side, the insurance guys, your bankers are going to be approaching you.
Great. Thanks, Luke. Let's see, David, should startups engage with financial auditing firms early on to prepare the financial documents for M&A in case diligence comes across?
Sure. I mean, again, I go back to the preparedness point. I think, and Luke made a really good point, I think, about how you can really, highlight to potential buyers that you're serious about the process. One of the signaling things that we see a lot, right, is, hey, look, we've got these really serious slate of advisors on board in any capacity, right? Clearly there's a financial impact of doing that, right, versus preparing your own. But most buyers will expect some kind of audited set of financials, right? They'll expect a QOE presented by one of the big four, etc. And again, it's all about timing in the process and affordability. But in general, I would say that's good practice, and that's not with obviously I'm slightly biased, right, because I work for the big four, but I just think in general it's good practice.
Thanks, David. So speaking on that advisory lens, Brendan, many founders don't know what sort of advisors are needed through this process. So can you quickly run through the skills on the advisory team?
Yeah, happy to. I mean, I think, the first thing you should consider, particularly for larger transactions, is engaging an investment banker. I think they can help you a lot through price negotiations, helping you through the process, helping you find prospective buyers, and helping you through the due diligence process. I think it may sound self-serving, but I think, a lot of the panelists here, I think, are some of the critical advisors that you should consider getting and that you probably need to do to have a successful transaction. So I think for all the reasons, David described, I think having, a good accounting firm to help you through that process, to help you defend your financials and purchase price adjustments, to help you put together a QOV report, if that's something the buyers request, which most of them will, is important. I think having good legal advisors to walk you through the process, and particularly legal advisors that have lots of specialists, because mergers and acquisitions can permeate through kind of all areas of the legal realm. You're going to need people that really know their stuff on IP, employee benefits and compensation, tax, data privacy, any regulatory regimes that your company may be operating under. So you really do need to have, I think, a law firm that has a wide array of specialists at their disposal to make your transaction successful.
Amazing. Let's see, Donna, I got one for you. What are some of the ways, having gone through it yourself, to simplify the M&A process? So we're going through the stages here.
Yeah, I mean, again, we've talked about preparedness so much. Like, I think David said we've already beaten this horse to death, but, really be prepared, right? And I know this sounds crazy because, I've been an early stage founder, and you're just super hyper focused on just fundraising and then hiring and then making the company successful, getting your first customer, and you're not really thinking about M&A, obviously, at that time, and rightly so. But I think the thing for me that helped consistently was just to always keep, everything clean, everything organized. And I think the bigger thing is be very, very strategic about it, right? I mean, you're going to get so much noise, and, you might have 5 different revenue lines, 5 different product lines, really focus on which one you think is going to be the best partnership or strategic value add for your acquirer versus going all over the place and trying to sell all 5 divisions or 5 product lines. Sometimes it's just that one thing is all that the buyer wants, and that's what you focus on, right? So the 2 key things for me is really just being very prepared from the beginning, not like thinking about it all the time, but talking about all the things that we've learned today. And the second thing is being strategic, right? You're going to get a lot of noise. Just focus on what the buyer you think is going to benefit from most, versus it's like your baby and you should acquire every part of the baby versus just like one part of the core feature core product line that the buyer would want. So yeah, I mean, it's not an easy process, and it's not for the faint of heart. It takes a long time and there's a lot of heartbreak, but you come out, at the end of it, stronger and better. So
I love that. Hopefully, yes. Let's see, David, how would you evaluate early stage companies under 3 million for M&A?
Yeah, I have to confess, Don, I didn't really understand the question. Maybe the person who wrote that in the chat could just
give a little bit more.
That a little bit, and we could come back to it.
Yep, awesome. We have had a flavor of optimism, but it does. I would be remiss unless I discussed what could potentially be happening out there in the market. Is could you address distress sales? So selling assets. Or just closing the doors. Are you seeing a lot of that? What are the best ways to approach that?
Yeah, maybe. So one observation I had is, I think some of the reason for companies kind of sitting on the sidelines a little bit is, maybe waiting for some of these companies to run out of cash. And it's like, hey, why would I pay? Not even a premium, right? But why would I pay market value for this now? Whereas if I wait a quarter or 6 months, hey, some of these, especially in tech, companies have such a high cash burn, right? And obviously raising incremental capital in this market, as Chris said on his slides earlier, is challengingly expensive. So, I don't have any specifics in terms of how to deal with that, but I think that is likely, right, as the market continues to perform as it's performing, is some of those assets will come to market, very, very quickly, because basically it's a fire sale, right, and they need to raise capital much faster than before.
Yep. Brendan, Luke, any comment there? I'm sure you have experience, Brendan.
I mean, I think that's exactly right. I mean, I think given the financing market, it's increasingly challenging, or at least, compared to recent years, to raise capital. So I think figuring out your cash runway, how much you have left, when to get your financing in order is important. And I do think David is exactly right that there are some companies who may become distressed from their cash burn, and that some buyers may be kind of waiting in the wings to be opportunistic about that.
I love that. Well, we're almost up at time, but I do want to get a couple of these other questions across. So generally speaking, from each of your desks, and Donna, I would love to hear your perspective on this. So aside from being prepared, which I believe is our common theme today, how does a founder, and more importantly, the C-suite team, become more attractive to developing M&A relationships with potential acquirers? Donna, I'll start with you, David, Luke, and then Brendan after that.
So the question is specifically the founders, or
correct? Yeah. How do you appear as an attractive M&A target in general, like as just a founding team? So, team is an integral part. So I have this template that I give all of the founders who are thinking of selling, right? Like just early on, I just call it like a M&A asset tracker. Technology is obviously the first thing. Team for me is the second. Then I go on to, your clients, your users, your revenue, all of that good stuff, right? And then funds raised till date. But team is incredibly important because at the end of the day, yes, technology and the platform or the product you're selling is extremely important. But if so many relationships have gone, south during negotiations because the founder was just really obnoxious or just did not get along well with the acquiring company, and I know these things shouldn't matter, but they do. So I think as a founder, you have to really show passion. You really have to care for the company that you're trying to sell, and if the buyer sees that, along with all of the other really core features and functions that we talked about of an M&A, your passion, your personality does come through. So I think just
making sure, you have that sort of, in the right mindset early on, I think is a good thing to do. And definitely networking, right? You can, gone are the days where you can just cold email a CEO and say, hey, I want to sell my startup, which, by the way, coupons.com actually purchased a company with a cold email, but that's getting harder and harder today. So, definitely networking. And I think, as the panelists have said, really engaging with their companies or companies like them early on, going to the right events, attending a lot more of these webinars, so you can really keep in touch with the right resources early on. I think that's a good way for the founders to get visibility as well.
Awesome. David?
Yeah, I would just, people buy from people at the end of the day, right? And I think that relationship between the founder and the management team and the acquirer is really, really important. So, and I think, even when the market was really, really buoyant, right, and there was a bit of kind of, perhaps arrogance from the seller's side. I mean, certainly in this market, I think it's really, really important. So I think Dana made the right point.
Awesome. Luke?
Yeah, I soft skills, and as we've mentioned several times, the general theme of this panel is being prepared and just approaching it correctly.
All right, Brendan, should I go for another question?
Yeah, but let's go for another question. I mean, I think that's exactly right. I mean, I think everything Donna and David and Luke said. I think also, at the risk of beating a dead horse, I think just getting your house in order, I think, is important. I think a well-organized company denotes a strong business and can support higher valuations as well, in addition to all the social aspects that were mentioned.
Awesome. All right, we have time for one last questions. Do any of you have any guidance on handling, or who you should ask to help handle, the cultural dynamics and differences for international M&A?
Yeah, I mean, I think I would say, if we talk about some of the challenges, the interpersonal stuff in particular, right, and the complexities that we spoke about, being prepared, all of that is obviously multiplied significantly, right, when you're dealing with cross-border transactions. So, hey, even if it's like, presentation of audited financials in, different currencies, for example, obviously the HR, legal implications of cross-border stuff. I mean, the magnitude of complexity increases significantly, and then, so therefore be prepared for that, Colin.
Awesome. Well, thank you, David, Luke, Brendan, and Donna for joining us for this panel. What an optimistic and holistic overview of the sell side. Thank you so much all for joining us. We hope to catch up with all of you in another 6 months, when hopefully the market looks a little better for all of our entrepreneurs out there. So thank you all.
Thanks all. Have a good day.
Thanks, everyone.
Thanks, guys. Take care.
Bye.
Alrighty, and before we take a quick break, I'm going to launch a poll just to let us know. You can raise your hand if you're interested in having a follow-up meeting with our partners. After this poll, we're going to take a short break and hope you can join us for our Growth Through Acquisition panel, the Buy-Side Insight and Overview. So we will take a quick 10-minute break after I end this poll. Thank you for raising your hand. And we will see you back at the 25 mark, which, depending on what time zone you're in, it's 10:25 a.m. Pacific. We'll see you back in 10. Looking forward to it. Thanks, everyone. All right. Welcome back, everyone. Just so you know, we're going to continue the live Q&A near the end of this panel, so please submit those questions for us in the Q&A box throughout the presentation. As you settle back in, we want to get a quick poll on the buy side. How many acquisitions are you planning over the next 6 months? So let us know from the buy side how many of you were interested in learning this in the beginning. So looking forward to this panel discussion. All righty. Looks like we've got a decent amount of votes. Thank you for voting. Let's see, I'm going to let this go for another minute or so. I'm going to end this poll and share those results. Looks like majority are looking for 1 to 3. There's some at 0 and some at 3 to 5. So hopefully our panelists will be able to help you navigate those. So on to our topic for this second panel, growth through acquisition, the buy side overview and insights panel. Without any further delay, please join me in giving a warm welcome to our special guests. We have Shalu Garg, who's a managing partner, late stage startups and unicorns at Microsoft. We have John Milner, M&A partner at KPMG. Emily Meyer, who's a partner at Woodruff Sawyer, and we have Michael Russell, partner mergers and acquisitions at Wilson Sonsini. Welcome, team.
Hey, Colin, how are you? Thank you so much for having us here once again.
Oh, love
Good
to have you back. Yep, great to see you. I'm just waiting for Michael to turn his camera on. We're good. All righty. Well, Shalu, over to you. Thank you all so much for joining us. Looking forward to this.
Fantastic. Thank you. Hey, everyone. Good morning, good evening, good afternoon, wherever you're dialing from. Thank you so much for jumping on. Really appreciate it. My name is Shalu Garg, and I am with Microsoft leading the pre-IPO and the IPO business there. I have been with Microsoft for about 4 years, although I feel it's like 10 dog years. But that's a conversation for a different time. I am extremely excited about the topic today. I've spent many years early in my early stage of my career in M&A, and so much learnings that I still today apply to my role, although I'm not in M&A, but I constantly am talking to investors and founders and everyone else. So super excited. The topic is growth through acquisition, buy side overview. So even better is the celebrity panel that I have with me today. I mean, I was looking at their bios and I was like, man, this is some really good pearls of wisdom that you all are going to get exposed to today. So without further ado, what I'm going to do is I'm going to call on each of our panelists. We have 3 awesome ones to introduce themselves for 30 to 40 seconds. And then let's get to the business or the order of the business today. So with that, Emily, how are you?
I'm good.
Green. We kind of, the coordination that we did offline worked out great.
It was. And I feel bad for the guys because we didn't include them. But
Exactly. Welcome.
Well,
I'd love for you to introduce yourself.
Sure. So I'm Emily Mayer, and I head the transactional insurance unit for Woodruff Sawyer, which is a all services brokerage based in San Francisco, but nationwide.
Fantastic. John?
Yeah, good morning, everyone. I'm not sure that a consultant has ever been called a celebrity, so I appreciate that one. I'll take it and run with it. I'm John Milner, and I'm a partner with KPMG in our deal advisory practice. And so I help clients primarily in the technology space evaluate, execute M&A transactions, mostly on the buy side. And that is everything from why we're doing the deal to doing the diligence and to value creation. So super excited to be here today.
That's fantastic. That's great. And Michael, welcome.
Hi, Shalu. Thanks. So my name is Mike Russell. I'm the co-head of the M&A practice at Wilson Sonsini. I've been at this for about 25 years. My focus is on private M&A, and by that I mean, the buying and selling of private companies, usually venture-backed technology companies. I do a mix of buy-side, sell-side, and investor-side representations. I have a pretty good sense of what all the different parties care about in these deals.
Right.
I do a lot of buy-side. Clients include Lyft, Dolby, Sumo Logic, Guidewire on the public side. On the private side includes GoFundMe, Everly Health, Netlify, Stripe, and others. So really happy to be here.
That's fantastic. Well, welcome. Sounds like we have amazing experience and talent on the panel today. So let me kind of just take it top to bottom. Let's start from the top. What, in your view, is the landscape today for M&A? Is the market ripe? Does it have an appetite? I remember when we were hit with COVID a few years ago, there was a lot of chaos in the market, including investments, right? The capital that was going in the market. And the constant talk track at that time was, well, consolidation is going to happen. There are way too many startups in the market, overlapping ones, so on and so forth. Year 2023, COVID is still kind of lingering around us. Every time I sneeze, I feel that, oh my God, I'm done with COVID. So it's still in our heads, right? How do you think the market is developing and how much appetite is there? I'll just go do the rounds and feel free to chime in. Emily, why don't we start with you? Would love to tap into your experience and thought leadership here.
Yeah, I think I would say that we are moving in the right direction after 2022. I think we can all agree that that 2021 is done. But I still think there's a way to go. I still think there is hesitation. I still think there's a gap between seller and buyer expectation around, right, seller hope around valuation. I don't think we found that middle ground. And I think that there is still, we've just seen the stock market respond again negatively to sort of inflationary figures. So I think, and there's still question marks around how much more interest rates are going to go up. So while I think people are getting used to this sort of slightly uncomfortable feeling of every time I sneeze, I'm dying of COVID, we're not yet ready to charge ahead into the brave new world.
Yeah. And when you talk about valuations, I know there was a lot of talk last year in year 2022 that the valuations were dipping. There was a lot of ambiguity in the market where these startups are headed. Do you think we are kind of recovering from those valuations, or it's still a long path ahead?
I think John probably has more insight into that than I do. I would say I'm still seeing situations where deals start at one price and finish at another. And that tells me what I need to know. But John, you probably have a greater level of insight.
Yeah, thanks, Emily. I would absolutely agree. I mean, I see a lot of transactions today that start at one price, and if they end, which is actually a really big question today and not the question that we were asking 6, 9, 12 months ago, if they end, they're at a different price. Today, what I see in the market is a huge gap between the bid and the ask, between what sellers want and think that their businesses still deserve and what buyers are willing to pay. And what we're seeing in the public market, which we all have seen over the last 12 months and the decline, especially as it relates to technology stocks, in the private markets, we still haven't seen that. I don't know if we're at an equilibrium right now. I wouldn't say necessarily we are, but that willingness and appetite of sellers to come down from a valuation perspective just hasn't been there. A lot of them are saying, my business is still great.
Yeah.
Key metrics are still up, be that ARR or something else. So what are you saying? I'm not worth the same amount that I was worth 6 months ago or 12 months ago, and my business is up 20 or 30%. And that's hard to rationalize. And so we're not seeing a tremendous amount of activity solely based on that bid to ask spread.
Yeah, I'm going to come back to you, John, and dig a little bit more deeper on the founder mentality when it comes to selling, right? Because they're mainly on the seller side. But let me just come back to you on that. Mike, would love to tap into your thought leadership here.
Yeah, sure. So I agree with everything that both Emily and John have said. I do think, we are seeing choppiness, but we are seeing a lot of buyers looking to be opportunistic, right? I think that's one of the interesting things that we see in these sort of cycles. I think there's still enough uncertainty out there that people are being very deliberate and intentional in how they approach deals. The buyers I'm seeing are willing to move slowly. They're doing diligence, aside from the valuation issues, a big adjustment for the sellers, which Emily, I know you know this well, is I see less inclination by strategic buyers to use rep and warranty insurance, which was a very, very powerful tool in the deals we were seeing in 2021. Sellers loved it. They could walk away from deals, maximizing the amount of cash they're getting at closing, not have the overhang of risk and clawbacks, after a deal is done. I think we're seeing strategic buyers now be much less inclined to use rep and warranty insurance, look to have the large escrows, look to make sure that the founders and investors have skin in the game on these transactions. So that's been a pretty interesting shift as well. I also see boards scrutinizing deals very carefully. They're really pushing management when they're bringing them deals on, hey, justify this valuation, justify the spend, right? Everyone's very focused on cash preservation. But what hasn't changed is I'm still seeing buyers that when they identify targets that are of strategic importance, they're being aggressive to go after them. So I have seen that. We continue to see that. But with some of the other deals, again, we see the opportunistic buyers being much more deliberate in their approach.
Yeah. And we're going to come back on the buyer side, Mike, because you made a very good point about if a buyer looks at a target from a strategic aspect of strategic importance, then they're willing to wait, right, for the right price and the right time. So I'm going to double click on that. But John, let's come to you. Most of the audience today are founder-based entrepreneurs, right? And I would love to tap into your brain power when it comes to valuation at the time of selling, right? I mean, we've been in this industry for a long time, enough to understand that when it comes to sell, everything comes down to the stock price, dollar to dollar negotiations, so on and so forth. What do you think are some of the areas that enables a founder to give into the selling process? So is it just the valuation itself? Is it, my company, I don't see much future in it? Like, what are some of the experiences that you have seen in the field yourself that could help the audience here?
Yeah, I mean, it's a great question. And look, when we think about valuation, there's always a market factor to it, which is what is the market going to bear, whether that's an ARR or revenue sort of multiple, rarely sort of an EBITDA sort of thing in these founder-led businesses, kind of given their growth trajectory. And look, founders have no control over that. That is the market dynamic. It's a timing aspect there. But probably the most important thing to do is to really focus on the key metrics to show the growth, the profitability, whether you're measuring something like Rule of 40 or ARR growth or churn or retention, focusing on those core metrics to tell the story and being able to convey a very convincing value story to a potential buyer is going to benefit you whether you're in a good market or a bad market from evaluations. When it comes to the rest of the multiples, the sad news is you're kind of at the mercy of the rest of where the market's going, unless you are in such a very specific hot niche business that there is incredible pent-up demand for that. And there are certainly a couple of those areas. We still see a lot of activity as it comes to cybersecurity. It's an incredibly hot topic, and it's an area where people tend to not necessarily follow broader market valuations, if you will. But I would say focusing really on the core fundamentals of the business to tell the story is going to help the valuations regardless of what's happening in the market.
I love that. Thank you for that. Emily, rep and warranties, heartbeat of the conversation here, a lot depends on execution. How do you think the market has been doing in the last few months when it comes to rep and warranties?
You mean in terms of the insurance or
the insurance? Yes.
Insurance, yeah. So really interesting, and the market has softened. It's a small market, right? We have 26 underwriters, which means it's incredibly responsive to market activity, which means it's almost like the canary of how much deal activity there really is, right? So I'll get underwriters telling me that they're terribly, terribly busy, but yet I'm getting 26 quotes on every deal, which tells me that they're not terribly, terribly busy, and that the pricing has gone through the floor also tells me that they're not terribly, terribly busy. I think what they're looking to do right now is diversify. So I'm seeing a lot of push around tax opinion, and can that be broadened from a purely M&A tool to an everyday tool, and more people writing contingent liability or litigation risk, and people willing to take a more risk-friendly view. I was recently looking at a tax risk that I think 2 years ago no one would have given me the time of day, and I got 3 quotes very quickly. So the market tells me much more quickly what's actually happening in the real world than what individuals might say is happening. So I think, we've seen pricing go down. We've seen diversification in risk. We've seen a willingness to take on more risks. I thought Michael's comment was fascinating about the strategics who've always had a different view of the insurance than private equity. And seeing that the way that they are both responding and utilizing it in different ways as the deal flow changes. And, you know, we've seen a situation where private equity is pretty quiet at the moment, but strategics are coming back more than they were before. And last year it was more that I think private equity is going to come back in the later part of the year when they think everything's bottomed down, and we'll see that reflected in the market as well. But I find it a fascinating a way of really getting a big picture from a small market.
That's great. That's awesome. So, Mike, I want to double click on a couple of things on the buy side. The first is I would say the legal aspects, right? Are you seeing flavors change in the market when it comes to legal aspects, especially the antitrust? I remember back in early 2000, that was a time when I was in M&A. And I was part of the acquisition. I was on the buyer side trying to acquire a company, which landed in trouble with DOJ. So there was a DOJ lawsuit. I'm not going to name the company, but it was one of the biggest ones which changed the direction of the high-tech industry, right? And I recall going through the process of how we were sending every email that said client confidential, so on and so forth. And I was like, why are we doing all this, right? And then later when the acquisition did come through and we went back and we said, okay, now it makes all the sense that we did. What is your point of view in terms of how are the legal dynamics changing in the market? And do we have to be on our toes when it comes to antitrust?
Yeah, so on the antitrust front, you know, I think we are still in an environment where the government is very focused on M&A. They're very focused on big tech. You know, it's hard to get deals through in the way that we were just a few years ago. And so that is truly a tremendous focus. You know, we had a couple of deals recently, one on the buy side where we have a great antitrust team, Wilson Sonsini, and they looked at it and they said, you know, prior administration, we would get this through right away. We should be prepared for a little bit more. We'll clear it. And sure enough, the DOJ did a full 30-day review. They asked us to pull and refile. They eventually cleared it, but they spent a lot more time on that deal than they would have in the past. I had another sell side deal we did recently where the buyer team was very confident there wasn't going to be, you know, any sort of second request or detailed review. We had a different view, and sure enough, the FTC dug in, and we're in the middle of a second review. So we are seeing a lot more antitrust scrutiny and review of deals that in the past just wasn't something that was a subject of their focus and attention. A couple of other legal things I wanted to mention. One in particular, I think is really interesting on the private side, is we're seeing a lot of stock deals right now, right? And again, cash is king. And so people are very focused on, let's be opportunistic. Let's look for companies that can add to what we're doing here. Let's grow through acquisition. But we don't want to use our cash. What do we do? And so a lot of people are looking to use their stock as currency in these deals. It leads to some really interesting business issues, the valuation issues, not just on the seller side, but the valuation of the buyer's stock, right? And what sort of rights are associated with the stock. On the legal side, you have really interesting securities law compliance issues, as well as related disclosure issues. On the securities law side, buyers don't often, especially if it's a private company buyer that hasn't been in the M&A world before, they don't really appreciate that when they use their stock, which seems like a great idea, that it's just like selling their stock at a private financing. They have to comply with the securities laws. We have to find exemptions. They have to focus on disclosures. They have to share information with the investors and the shareholder base on the other side so they can make an informed investment decision. We spend a lot of time with clients thinking through those issues and protecting their disclosure as a private company, but making sure that they're complying with the securities laws and doing so. On the exemption side, you know, we had a recent, just last year for GoFundMe, we did a fairness hearing, which is a really fascinating process in the state of California where the target had a really large cap table. We wanted to issue stock. And it's hard to comply with the securities laws normally where there's a rule of 35 investors to be able to do it. But we went through a mini registration process in the state of California, and we were able to do it with a cap table that had around 400 shareholders on it. So there's some really interesting legal issues that we're digging in on and helping our clients navigate so they can do the deals that make sense and use their stock when they want to. The last quick legal issue to mention that we're seeing a lot of on the Delaware side is we're seeing a lot of M&A deals as down rounds right now, right? We're in a distressed market in some cases. Investors are not willing to put more money in. They had very high valuations in their last round of financing as a target, and they're not able to reach those valuations when it comes time to sell. And so figuring out ways to navigate those issues and work through the cap table and figure out what is preferred getting, what is common getting, how do we make sure that everyone's interests are protected? There's a lot of really interesting and sometimes challenging issues on the private side, given how interested many of the VC board members are. It's their investments. The founders are interested. They're rolling over to the buyer. So there's a lot of challenging issues that we work through.
Yeah, and I want to double click on your comment about cap table. I'll just share an experience. Early last year, I was working with a founder in the automotive space who was looking to raise Series B. And I recall having a conversation with the CEO, who was also a founder, saying, hey, what's your broad stroke of vision? And he said, you know what, I'll get this deal done in 3 investors. Here are my top 3. And last December, he had 22 signatories in terms of investors. And, I remember speaking with him right before Christmas, and I was like, what about equity? You've kind of signed off your equity 3 versus 22. And he was like, what do? I need to push the business. And there's some win some, lose some. So the dynamics around cap table is super interesting. And I haven't seen many deals yet because it's just the beginning of the year, but I'm curious to see, how the rest of the year goes. So thank you for pointing that out. I think that's loud and clear that came out from the market last year. Thank you for that.
Sure.
John, KPMG, you're cutting deals almost every day, right? Tell me what is happening in terms of the market activity right now. What is your observation? So Emily talked about rep and warranties. Mike touched on the legal aspects, the antitrust. Let's kind of level up and see what are some of the dynamics that are in the market that you're picking up on.
Yeah, and when we were having these conversations 6 and 12 months ago in these boot camps, it was go days, right? To your point, our clients were closing deals every day almost. Today, that market is significantly down, just from an overall deal volume. Emily mentioned it. You're getting 24 quotes from 24 potential underwriters in the market. Things are slow. We're seeing the same thing in terms of what's happening, in particular on the buy side. Deals that come to market are taking an extremely long time to get to sign and then close thereafter. Buyers are doing a lot more diligence. They are more in the driver's seat through the process than they were 6 to 12 months ago. So the activity overall is just down. That's the reality of where it is. You are seeing pockets, as kind of Michael talked about, on the corporate side versus some of the PE side. And we're seeing that too, where I think we're starting to see, I don't want to call them green shoots. I think it's people starting to prepare for the eventualities that may happen over the next 12 months, is more and more companies are starting to think about what the next step is from a sell side perspective. So how do I go raise my next round of financing? What's that going to look like, and how is it going to prepare? To the point that you just mentioned, I thought I could get 3 investors and do it in a couple of days, and I'm 22 investors 6 months later still trying to get the round signed. We're seeing that sort of activity, and we're seeing companies start to prepare to realize it is going to be a longer fundraising cycle. I'm going to have more data requests, more information needs from potential investors or potential acquirers. And so starting that kind of sell side process to present the business, to package the business outside of the investment banking context, but including that, but also just through other sell side activity, getting ready. Nobody's saying, let's go hit the market, send the books out next week. It's let's get everything ready so that when the market does open, because I think there is a lot of just belief in the overall ecosystem that the market is going to come back, and it's going to come back hopefully pretty quickly, but that might not happen till later this year. let's get companies in the right place to start taking advantage of that really quickly.
Yeah.
That's what we're seeing a lot of companies start doing. But it's just really interesting because, I had one client that was talking about doing an additional fundraise. Again, kind of similar story, thought that would be pretty quick. And, they just signed and closed a investment round that was highly structured. They got around not calling it a down round by putting a lot of structure around that particular investment, which came with a lot of rights for those investors. And, you're starting to see more of that, which isn't necessarily the most founder friendly.
Yeah. I love what you talked about preparing for the future. And that speaks volumes, right? I remember, and also the buyer being in the driver's seat. Up until like few years ago, the founders and the sellers were in the driver's seat, right? And not to say they're not in today, but it's almost like the due diligence process is painful now because you get down to the P&L, the balance sheets, your spending expenditure, your CapEx, OpEx, everything. You just have to put it out on the table. It's non-negotiable. So it's an interesting space. And as I mentioned earlier, just curious to see how the market performs later this year. Okay, let's switch gears. We've been talking about M&A. Let's talk about private equity. Lots of activity in that space as well. PE buyouts, late stage companies. Couple of years ago, there was this very fancy term SPAC. We saw a lot of momentum there and a lot of companies suddenly going away. And it was like, I have to tell you, I have to share this with you. It's been 2 years. I was working with the CIO of a startup, Series D, that were funded 200 million SPAC. And I recall him calling me and he's like, I want to change my company. I want my company to be the enterprise of the future. I want to change the tech, the HR, everything. And 6 months into, they were out for sale, in simple words, right? And so I want to tap a little bit into the M&A activity versus the PE activity. And in the PE space, of course, you have PE buyouts. Sometimes you have SPACs as well. What's your observation on that? How has the market changed or developed in the last 1 year, and where are we headed? Emily, I'll start with you if you're okay with it. Your point of view, please.
Yeah, so we're lucky. We have a split book. So by which I mean sort of half our clients are strategics and half our clients are private equity. So we get to see sort of both sides. What I'm hearing is they still think there's bottom to hit, right? That strategics are taking an opportunistic kind of, let's look at it and let's see where we can do. It's always been easier, I think, and this may be a rash generalization, but I think the process for private equity when they decide to buy a company is less cumbersome than it is for a strategic, right? You need to go to the PE board and they sign off, but in a strategic, there's a lot of people involved in the decision making, and it's a lot more complex process, and there's a lot more buy-in that you have to get. So I get the sense that private equity is sort of poised like a tiger right now. They think that there is further to go down, and they expect, I think, second half of the year to be a lot more active than they are now. We have been saying for as long as I can remember that there is so much dry powder that needs to be deployed, that's now becoming a sort of ridiculous cliche. And the fact that it hasn't been deployed implies that it didn't need to be deployed. But we must surely be coming to a point where they're not going to be able to continue fundraising if they don't actually show some action. So I expect to see more private activity in the latter half of the year. And I expect strategics to sort of continue in this sort of looking for opportunities, focusing more on smaller deals because they're easier to get everybody to buy into than really big deals. I think the middle market is probably where we're going to see it come back and thrive first.
That's great. That's fantastic observation. Mike?
Yeah, one of the areas we've seen a lot of private equity activity within the last year have been not necessarily focusing on the companies that went public through the de-SPAC process, but a lot of recent public companies that went out in 2020, 2021, software companies where their valuations were hit pretty hard in the public markets after the initial high valuations that came down. So we saw a lot of take private transactions with some of those newer public companies. That certainly slowed down recently. On the private M&A side, we were seeing PE in all deals. Again, looking back at 2021, early last year, they were really involved. They were really active, and have seen a lot less PE activity, in the recent past. Agree with Emily. I think that they're going to be very thoughtful about when they go back into the market. So I do think now is a really ripe opportunity for strategic parties to focus on deal making.
That's great. John?
I absolutely agree with both Michael and Emily. I think this is the opportunity for strategics here right now. It's funny, that private equity isn't very busy when you can always take them to lunch, you can always take them to dinner, take them to a game, anytime you want, you can call. The only thing that's really challenging on their calendar is if they've got a ski trip that they're traveling for. Anyway, way of saying that they're just not very busy right now. And they just don't see the valuations coming down to meet where they think that they want to transact from the buy side. What they're really focused on is really helping their companies within their portfolio drive value. So how do they extend cash within their portfolio? Whether that's reducing cost or leaning into the go-to-market motion to drive growth on the top line. They're focusing much more there while still keeping a little bit of their time in how do I build that funnel so when sellers, we kind of come to a normalization, if you will, in terms of valuations, they're willing to pounce. When that happens, as Emily said, they're going to pounce really quickly and attack that market very, very fast. But it's just going to be some time before they're ready for that.
Yeah, that's good. So let's switch gears and be in the seats of corporate buyers. I want to kind of double click on that because most of the audience today are entrepreneurs. So Emily, question for you. What is the due diligence process that a corporate buyer typically goes through? I mean, what are the signals that they're looking for? And I'm pretty sure it's just not valuation. It's almost like you doing capital investment, right, in a company, and there are parameters and facets that you look at. When it comes to acquiring, what are some of the big, chunky signals that corporate buyers look for, especially in this market?
Yeah, no, that's a great question. And the due diligence, the way due diligence is approached by strategics and private equity, I find to be fascinating and very different, right? Private equity will have their advisors that they go to, and they have their standardized things that they're looking at. Corporates are in the business usually that they're acquiring. And so they have and it's often an issue in rep and warranty, right? Because what the corporate is looking at, what they care about, is not the same holistic picture that a rep and warranty underwriter will look at, right? So we spend a lot of time helping our corporate clients sort of prepare and memorialize and put together the kind of diligence that's going to maximize their coverage. So they are, for instance, when we look at financials, and I'm sure John has an opinion on this, they will look at a much smaller range of financial triggers because they're looking at a very specific, I want to see how this is going to integrate into my bigger system. So I want to value the cost of production because I know I can make the production this much cheaper if I do this sort of thing. But I'm not so worried about, and these are just examples, but I'm not so worried about aged receivables because I have a really clear picture in my industry of how long all these people take to pay. And we have many of the same customers. And so I'm not so worried about validating that data, for instance. Whereas private equity will be like, no, we're validating everything, right? Because that's what we do. We look at everything. So what I find is that the diligence process for corporates is much more specific to the industry. It tends to have a narrower focus based on where they think they're going to get the most valuation or why they're buying this company particularly, rather than a sort of holistic all-round approach, which is not to say that they're doing less diligence. They're doing just as much work. It's very focused in sort of specific areas. Tech will look at a different set of parameters than CPG will look at, whereas I find that the diligence process for private equity is more universal. And I would be interested to see if Mike and John have the same experience.
Mike, John?
Yeah, very similar experience. I think that, I'm mainly working with strategics, and they're very focused on, how does this company fit into what I'm doing? How are they going to enhance our product portfolio? How is this team going to add to what we already have? How are they going to help us, deliver more revenue? It's, very focused on how they fit into what that strategic is doing. Whereas on the private equity, they're buying the whole company to continue usually running the whole company unless it's part of a roll-up strategy. And so they do take very different approaches to how they look at diligence and where their focus is. So I agree with everything that Emily said.
And Mike, in your experience, obviously you alluded to earlier on around the buyer's side as well. Who do you think has more power at the table right now? We talked about valuations. I get it. I mean, it's a very volatile market, right? It's crazy market, right? But who do you think has, if you consider strategics, and if you consider that, hey, here's the cash I have, I want to be extremely astute where I deploy my cash for a higher ROI, then where does a shifting of power kind of kicks in?
Yeah, no, I think in what I've seen, especially compared to 2021 and early 2022, the leverage has really shifted to the strategic buyers. If you think of 2021, 2022, those strategic buyers were competing with investors who were still willing to invest in these companies and run them as private companies. They were competing with the IPO market. They were competing with the SPAC market. They were competing with private equity. Guess what? A lot of those players are not in the market anymore. There's not any IPO activity. The de-SPAC activity has really died. And so you went from the situation where buyers were really worried about missing out, right? And sellers could command a lot, valuation terms and otherwise, to again, where you have a circumstance now where the strategics are, in my view, really able to be in the driver's seat if they can maintain the discipline. There's certainly very strong private company targets out there. And again, those strategic deals that make sense, where those sellers don't have to sell, they still have a fair amount of leverage. And you still see, favorable target terms, favorable target valuations. But given the rest of the market, given that we see a lot of targets that are running out of cash, where VCs are unwilling to put more money into them or are willing to put money into them, but on very tough terms, buyers are in a much stronger position. To the point that John made earlier, sellers continue to wrestle with these valuation issues. So that's still creating a lot of challenges in getting deals done. They're still trying to get their heads around where things are now. But from an overall leverage perspective, I see that the buyers are in a much better position than they were, 6 months ago, 12 months ago.
That's great, which actually leads me into kind of words of wisdom question, which is, Mike, to your point, and I'll go around the panel on this, any kind of words of advice for corporate buyers when they look at the term sheets, when they look at the total addressable market size, when they're out there hunting for the next big target? Any words of advice for them?
Yeah, I'll focus on the legal piece and let John and Emily chime in their area. My advice to buyers is, again, it's a great time to be opportunistic, but be patient, be disciplined in how you approach it. Make sure that you really stay focused on the strategic rationale why you want to do this deal. Really test yourself as you go through it. Does this deal still make sense? Does it still make sense at the price that we offered? From a practical point of view, the one piece of advice I give my buyers all the time, and I see it play out, do a detailed term sheet negotiation up front. So often there's this sense of, well, we don't want to involve the lawyers. Let's just get a handshake deal done. Let's jump into definitives. Let's get somebody locked up in exclusivity. Those deals, the only people that win are the lawyers, because if you push off negotiating all of these detailed terms to your 100-page definitive agreement, you get bogged down. It creates a lot more time, energy, cost, a lot more management distraction. It creates a higher probability of, tension with the founders and, between the buyer and the target and the key people they want, because instead of having things figured out up front, where people largely nod their heads to the material terms, or you have that back and forth on the business level, if you get drawn into that on a legal level and you get involved in these fights over a lot of issues that you could deal with up front, it really harms the overall deal and ends up costing a lot more, both in terms of time, again, management distraction and legal fees. And again, sure, I win if I have a big legal fee, but it's not a fun deal. My client's not happy. The target's not happy. That's not good. And so I really encourage my clients, both on the buy side and sell side, use that time up front. Once you decide you want to do the deal, to really focus on what those key terms are and reach agreement, so that the lawyers can focus on executing and not showing everybody how smart they are, and all of those sorts of things that can really bog down the strategic rationale and the commercial rationale for a transaction.
That's great. That's awesome perspective. John?
Yeah, Michael mentioned the strategic rationale, and I think that is the most important reason why somebody does a transaction. And I see this more common in the corporate world, that doing an M&A deal sounds sexy, it sounds fun, everybody wants to get a deal done and wants to do a deal, but they are incredibly disruptive. It takes management's time of the buyer away from running their business. When you think about integrating a business and a product, whether you're changing a product roadmap, integrating the back office, it's a lot of disruption. And so you need to make sure you're doing it for the right reasons, not just because you want to go do a deal, or you're worried that somebody else is going to do a deal that maybe might impact you. You have to have really strong conviction that this is really going to move your business forward and create value for your shareholders, because the path to get a completed deal done and something integrated to actually reap the value that you're buying is a very long path. It is very expensive and is very time consuming. And so going into it with the right reasons, I think, is really important. And if we rewind the clock 18 months ago, people were doing deals because they felt that they had to. They felt that the digital transformation was going to pass them by, that if they weren't at the table at every single transaction in their industry, they were going to get left behind. Today, I think that has changed a little bit with where we are in the market dynamics. You can take more time. You can be patient, especially when we think about the strategics. You know your industry. You know who the people that you want and will be accretive to your business, or if they're in the adjacencies of where you're going to go expand. And so it's having that patience, it's doing it for the right strategic reasons is going to be helpful, because there is so much disruption and cost.
Yeah, I'm going to double click on the word disruption. Something that we haven't touched during this conversation today is integration, right? And I've seen both sides of the world. I've acquired companies, and I've also been on the other side after acquiring them. They weren't accruing revenue, and we were bleeding because customers were just leaving us. There was customer attrition. And so the integration also plays in really strongly into the rationale of acquiring companies. Are we equipped to integrate the company, right? Are we ready? Because oftentimes I've seen, especially in the big tech space, there's a lot of cash, right? And you kind of just want to deploy because you want to get ahead of that competitive curve in the next 2 to 3 years. And you say, yeah, I have the cash, let me just go and acquire. But are you ready to integrate and bring this mammoth of a company, no matter how big or small it is, in terms of employees, but actually soak it in within the existing organization and call it a successful acquisition? And I know there was some metric, I recall seeing it last year, that a very high percentage of acquisitions are actually not successful because there isn't enough thought given to post acquisition, and it's just about deal making only. So thank you for bringing that up. Emily.
Sure. So I couldn't agree more with Michael on get the terms nailed down in the beginning. And that applies in my world too. We'll be asked to go out and get quotes with an LOI that has a vague amount of information. I can get you a quote, but it's largely meaningless, because what we really need to see is how they're going to respond to the terms and conditions. And if you don't have those terms and conditions in place, it's very difficult when that changes. As the deal changes, you might end up with not the coverage that you want, because when they originally quoted, you weren't envisaging this particular deal term or mechanism. So I think couldn't agree more on that front. Also couldn't agree more with John on I think that the slightly dirty secret is we can have all the spreadsheets we want. Buying a company is still an emotional decision, right?
Yeah.
None of us really want to admit. So, the disruption that causes, right? And I think it's absolutely right. M&A is a confidence game. And when everyone was feeling very confident, we saw a lot of M&A. And now we have sort of the reverse situation where everybody's very nervous and nobody wants to move forward. And so I think really focusing on understanding, that there are good strategic rationales for buying it, but also checking yourself in terms of sort of what's the emotional reason behind this purchase, and does it make sense in the context of the strategy, or am I sort of convincing myself that this is going to be a great deal because I'm excited about the idea, or I'm afraid of being left behind, are where we see deals fall apart, where they weren't clear at the beginning, or where the reason someone's buying is not what it appears to be. And then that all comes to play as the negotiation happens. And that's when everybody comes away very unhappy.
Yeah, that's great. Well, I don't know about the audience, but I've definitely soaked in quite a bit here. I know there are questions coming in from the audience. So if you don't mind, let's switch to those, give breather here, and let's just see. Wow, there's some really interesting ones. So I'll just leave it open for the forum, whoever wants to pick it up. The first one, isn't this a great, fantastic time for earlier stage companies to merge and grow through acquisitions? Anyone wants to take it? Early stage, right candidates.
Let me start on that. And so, and this is really touching on the point that John was just hitting on. It may seem like a really good idea, and it may make sense to bring some companies together, but it is really hard to do M&A. It is, takes a huge amount of time, a huge amount of energy, a huge amount of distraction of management. It can be an emotional roller coaster ride. It's going to cost you a lot of money to do a transaction. And again, there are a lot of transactions that don't succeed because it seems like a good idea, but you spend a lot of time getting a deal closed, and that's really just the beginning, because then you have to focus on the integration. So, if a deal makes sense, and if it makes sense to bring two companies together, you should certainly look at and pursue that deal, but you should go into it with your eyes wide open. I don't know how many clients ask me at the end of a transaction, how do you do that every day for a career? That was the most exhausting, emotionally draining experience I've ever gone through in my entire life. How can you do that every day? And I do it because it's great, and we have great clients, and you have a real sense of satisfaction helping them bring companies together. But it's not for the faint-hearted. And so if you're gonna, don't just do it to do it. Do it if it makes sense, but go into it with your eyes open and be prepared for a lot of, again, that disruption. I think that was a great word that John threw out.
Yeah,
that's great.
Absolutely agree, with Michael there. I think the challenge with early stage companies are they're be so focused on the product market and the growth that they're driving, that taking that limited management bandwidth to do a transaction, it has to be for absolutely the right reasons. It can't be just because we think it might be a good opportunity. It just generally doesn't lead to great outcomes. In part just because they don't have the muscle memory. You look at very large corporate acquirers, the biggest in the Valley or across all of TMT, and they're doing 12, 20 different deals a year, sometimes more. They have an entire machine behind it to do it. When you're a 5-10 person management team, you're not going to run a business for the next 6 months to do a deal.
Yeah, and just to add to that, your systems, it's hard enough to integrate systems that are well established, but integrating systems that are still evolving is going to be practically impossible, right? Your trajectories are unlikely to be aligned in any way. And so if it's a merger of equals, then, even who makes those decisions becomes a contentious point.
That's great point of view. Questions are flooding in. So let me take the next one, if that's okay. Given the fact that the Fed isn't likely done with rate hikes, oh my God, don't even get me started on this. Is it better to just wait until the fall to start to acquire companies, aka the bottom of the market? Great question. wait. It's almost like I feel sometimes these deals are almost like buying real estate, right? It has similar connotations, emotions. Emily, you talked about emotions, right? And it's almost like, am I making the right decision? Is this the right time? Should I wait for the interest rates to drop? So, what do you think? What's your perspective on this? Anyone can take this.
Yeah, I think I wouldn't worry about where the rates are in the market from an M&A perspective. You can never time the market. And when a really critical, very valuable asset comes to market, you should be ready to jump on it.
I love that.
Yeah, rates in my discussions with clients, rates impact private equity. And I have never had a discussion about where the Fed rates are with a strategic client. And in private equity, it mostly only matters for middle market and the very largest of public take privates. And everybody else are finding creative ways. There are a lot of other types of lenders out there and the other stratifications of private equity. They're either writing full equity checks, knowing that they'll go refinance the deal once the market's better. So they're going to take the timing impact of it. So as a corporate acquirer, I wouldn't worry about rates.
I would say, though, that I think that rates are more likely to impact the portfolio companies of private equity than it is to impact private equity's ability to sort of raise money or buy things, right? So I agree with John. I don't think that's impacting anyone's sort of decision about whether we borrow money or how we leverage. But I do think it's causing that concern in the sense of, well, I'm not sure what it's going to do to this company that I'm thinking of acquiring. Right. In terms of if interest rates keep going up, is basically there going to be no market for these luxury goods or no market for this estate seller, right? Rather than me, myself being impacted by the rates.
Yeah. And also from the seller perspective, there's always that it's again, you're in the market to buy real estate. Is this a good time? So you're constantly in self-conflict that maybe if I wait, the prices will come down. So back to your point, John, I love what you said, which is, if it works for you, do it, because there's never a good time. It just comes down to the right time when that decision has to be made. Great. Okay, I see more questions coming in. You guys are popular. See, John, I meant it when I said celebrity. There was a reason I said that. Okay, let's move on to the next one. When a company is acquired, how often does a team get to stay? In what scenarios do they typically get replaced by the acquirer's people? I think this is more a subjective question, but I'll let the panel respond to it. Who wants to take it?
Yeah, I'm happy to start.
Yeah.
And again, we all approach these deals through our own worldview and what we see every day, right? And so again, the world I operate in is, working with venture-backed technology companies, buyers and sellers, right? And one of the greatest assets in most of those transactions is the team. And there's been a tremendous amount of deal activity as long as I've been doing this that has been driven by, buyers looking to supplement their team, right? Bring in great people that are going to add to whatever it is they're doing, help them develop a technology that they decide would be better to buy than to build, right? And those are all the things that go into a buyer's decision-making process. And so most deals that I see, the team is a key critical focus. Clearly, they've developed a technology the buyer's interested in, but there's often a tremendous focus on, we want this group of people. We think they can be really additive to what we're doing. And so that's often a big driver for the deals, in which case the team is coming across. In the current environment, we're seeing, situations where buyers are focusing more on some of the cost synergies, some of the overlaps, thinking about those issues in a way that, again, 12 months ago, they just weren't thinking about in most deals. So it's certainly an area of focus now in a way that it wasn't so much in the recent past. But still a lot of the focus is on the team and the talent. And so that's hopefully responsive to that question.
Yeah, and talent retention is critical because obviously you have the customer base. That's the reason you're acquiring the company. I mean, there could be a variety of reasons, but there's customer base, there's partners, so on and so forth. So talent comes in handy there. Okay, one last question. I know we are almost on time, but this is a popular panel, so we got to do this. Okay, last one. Advice on structuring earnouts to avoid danger pitfalls. Anybody wants to take this? Emily? Is this
All
you?
I can say is we're seeing a lot more earnouts. That's certainly, when I see a price move, that's the direction I'm seeing it move in, right? We start out, it's 100 million, and then it becomes, well, it's 70 million with a 30 million earnout, right? I think that is an obvious risk mitigation and management tool, especially when people are trying to work out what projection is even a reasonable thing right now. But John, I know you have some thoughts on this.
Well, no, I always laugh when earnout questions come up, and I sit in a very different place than where Michael does, who probably deals with this more day in and day out. My advice to every buyer or seller is avoid earnouts at all possible, because it only leads to conflict down the road. And in my area, it's how do you manage what you actually signed up to for the earnout? Is it revenue? Is it profit? You know, is it headcount? Is it retention? Is it a milestone? It just leads to dispute. The more money you put in an earnout, the more reasons there are for the sellers to try to dispute the outcome of that earnout. And I think it just adds complexity. I think people need to understand where the value of the business is today. And if there's retrading, are there other places to retrade other than an earnout? Then that's always my advice. And I realize that's not necessarily always practical, but I rarely have ever seen earnouts work effectively.
John, I give the same exact advice you give. So, and some deals you need them, right? Because some deals, the parties want to do it and they can't get there for valuation, right? So they look to the earnout as a way to bridge that gap. But they are wrought with peril on both the buy side and the sell side, right? A sophisticated seller is going to push really, really hard to make sure that they are going to optimize and maximize the chance to get that earnout. And the buyer is going to be very focused on not having its hands tied, right? They're saying, we're investing a lot in this asset, but we owe fiduciary duties to all of our shareholders, and we're going to do what makes sense to run this business. And if things shift, if things change, then guess what? You know, we may not put support behind this earnout. And that's why, you know, to John's point, not only does it almost inevitably lead to disputes post-closing, but it can lead to a lot of work pre-closing and identifying the milestones, identifying the targets, agreeing on objective measures, agreeing on how much support the buyer is going to give, agreeing on how much autonomy the sellers are going to have, right? Are we going to be able to focus all of our energy on reaching this earnout, or can the buyer deploy us to somewhere else within their organization, you know, a month after we close, because that's a higher priority? So they are very, very challenging. In the right deals, they make sense because the parties want to get the deal done, and it's the only way they can agree on valuation. But they have a lot of challenges associated with them.
That's great. So I know we are on time here. It's time for wrap up. But firstly, awesome conversation. Really enjoyed it. I took some notes here. So as a wrap up, I'm just kind of going to repeat back the conversation threads that we had. We definitely talked a lot about valuations and the fluctuations that are there. We talked about strategic buyers, the board scrutinizing, diversification. Emily touched on it, antitrust. We also talked about preparing for the future. I love that thread where, you know, just be ready, start to look through scenarios. We talked about the private equity activities. I love the word M&A is a confidence game. I mean, just use that. And then in the middle of all of this, at the end of the day, it's about emotions, right? And making the right decisions when it really matters. So with that, I'm going to wrap it up. Thank you, Emily. Thank you, John. Thank you, Mike, for such an amazing conversation. I really appreciate it. And with that, I will give it away to Colin. There you are.
Hey, yeah, thank you so much, Shalu. John, Emily, Mike, really great to learn from your insights on this buy-side panel. Shalu, thank you so much for leading such a great discussion and bringing the optimism that you always do to the table. Appreciate you all.
Thank you.
Thank you.
Yep.
All right, bye.
Thank you all so much for joining. As one last poll as we roll out to close this session, if you'd like to learn more from our partners on any of these subjects or more, let us know in this poll. And also, we have a section in there that you can submit feedback to what programs you'd like us to be hosting in the future. So let us know there. We hope you enjoyed our sessions today. Thank you for voting in these polls. Looks like everyone enjoyed it. Great session, great session. Thankful for all. Great. Well, we are so thankful for all of you joining us, and we look forward to welcoming you all back online soon. Hope you have a great morning, afternoon, and evening, everyone. Have a good one.